So as we look at exiting a deal, we're going to then say, hey, this is a candidate. We're going to go do a 1031 exchange and find something. But if we can't find something, no one really wants to have a situation where you can't place money and you have that big capital gain at one point. I mean, that's where the DSTs are useful as well. If people have a deal that they know they want to exit and they want to move away from just owning one asset, it's like it's a great way to do it.
We believe here at Capital Gains Tax Solutions that buying at optimal timing, like kind of all the stuff that you're saying, like staying within your lane for what you're really good at, and then not deviating from those parts of it. And for the investor who might be selling out of a business or commercial real estate, or and they have this huge capital gains tax, right? And maybe you get those calls where they say, look, I'd love to invest with you, Dave. I want a 1031, and you may or may not have a fund that qualifies them to be able to do that, or you don't have a deal lined up to do like a tenant in common type of structure. But what would you say is your biggest frustration when it comes to capital gains tax in the 1031 exchange?
I would say not having a plan. A lot of times you'll see people that they made a lot of money, they have a 1031, but then you kind of get annoyed that you have to pay taxes. It's like that's the result of making a lot of money, is that you then have to pay taxes. So unless you're open to what the potential solutions are to solve that or to defer them, you got to be creative in what you're looking to do. But I would say most kind of like challenging or frustrating part of it is that everyone knows if you earn money, you have to pay taxes. So you can't not be aware of that. So I think every time you're looking to sell an asset or you're looking at your plan going forwards, you've got to look beyond just the current deal, just the execution of the closing, and know what your long-term plan is, and that you have a way of executing it.
Excellent. And on the front of 1031 exchanges, when you guys are exiting and doing assets, how is your structure? Are you guys syndication model? Are you guys fund model?
Yeah.
Are you guys a little bit of both?
So
walk us through
we're
that.
an individual deal fund model. I mean, we're individual deal, not a fund model. So as we look at exiting a deal, we're going to then say, hey, this is a candidate. We're going to go do a 1031 exchange and find something. But if we can't find something, no one really wants to have a situation where you can't place money and you have that big capital gain at one point. I mean, that's where the DSTs are useful as well. If people have a deal that they know they want to exit and they want to move away from just owning one asset, it's like it's a great way to do it. But they should go in with that plan ahead of time and not wait till the last minute to try and figure it out.
Yeah, I could agree with you more. We call it the shotgun wedding, right? When you're forcing a marriage in 45 to 180 days in a situation where you don't necessarily want to be in, especially with interest rates being so much higher right now and values not necessarily shifting as quickly as they might be. And so having an option like the deferred sales trust to exit, defer your tax, and then invest at optimal timing, all tax deferred, into real estate. The 2008 crash, it took till 2011 to see the bottom of real estate values, right? Not that we think that's coming or anything, but there's definitely some challenges ahead. And the question is, how long is it going to take for those values to shift? And so having liquidity, diversification, the ability to pounce is great. Also, from someone like your perspective, I would imagine too, Dave, that people might call you with a business sale. They might call you with cryptocurrency or stock or something, a primary home that's not even 1031 eligible to go into a 1031 like a tick carve out. And they're going to pay a bunch of tax, but they want to be in real estate because it's very stable and they trust your track record and everything you guys are doing. This deferred sales trust can be that bridge that bridges the deferral of the tax right into your deal without having to be a 1031 or a carve out. It just comes in as an LP. It's just seamless, just like any of your other LPs. What are your thoughts on that, Dave?
I mean, it's a great strategy, a great solution for doing it. I would just say, in my shoes, I'm purely the real estate operator looking to put LPs together. So we don't necessarily go try and like do all that stuff in-house, right? Like we want to partner with someone that's able to do that for an investor. So it's a smooth process. Like we know our skill sets, and in your shoes operating the DSTs, like it's not something you just sign up for day one and say like, hey, I can magically do this as well. So I think you just making sure you have the right people in place and the right partnerships on how you're working with individuals. And it can be a huge advantage to people that are taking the time to, learn what the best scenarios are out there.
Absolutely. If people want to learn more about that, you can go to capitalgainstaxsolutions.com. You can also check out the new book that just got released, Building a Capital Gains Tax Exit Plan, hit #1 bestseller on Amazon for some of the categories like real estate and investing and wealth. So check that out.